Hello, everybody. Welcome back to another episode of the Mouthy Money podcast. We have an extremely special episode today because not only are we not recording remotely, which is our typical setup, we are in studio in London, and I am joined by two venerable guests, I will say. I am joined by James Daley, who is the founder of Ratings and Consumer Group for Finance, and Robert Vaudry, who is Chief Customer and Investment Officer at Wealthtime. Both of you, hello, welcome to the podcast.
Hi, hello.
Thank you very much, both of you, for joining me. I've got you with me today to talk about something quite specific. It's a tricky topic, and not one. Well, we've tackled pensions quite a lot recently on the podcast, and it is something that we do seem to be talking more and more about. And I think that reflects how important it is as a topic, even though it's one that a lot of people maybe shy away from. We're here today to talk about jargon in finance, and more specifically, we're here to look at the difficulty of communicating the moment in life when you go from being a person who works and saves into a pension primarily to a person who no longer works and basically uses your pension to live off. Now, that's a really complicated way of saying retirement, but there is kind of a specific issue around that I think Robert, Wealthtime have kind of become aware of, is that right, on recent roadshows and that kind of thing.
Yeah.
Which we're going to dig into more, and I'm going to get you to give me more on. Before we go dive too far into this, because I'm getting carried away with the topic already, I need both of you to tell me who you are. James, do you want to start? Just give us a bit of background on yourself and what you do.
Fairer Finance is, as you said, a ratings and consumer group. We've been around for 10 years this year. We do two types of ratings: customer experience ratings and product ratings. And perhaps our special expertise in this area is driven out of some of the work we do in our customer experience ratings, where we, as well as doing polling and looking at ombudsman complaints data, we do what we call our transparency analysis, and that includes mystery shopping the clarity of information in providers' customer journeys online, and also analysing the clarity of their terms and conditions and policy documents. So we are very familiar with the world of jargon. I've got some good stats I can share with you later. And we do a lot of work with firms across the financial services sector, rewriting terms and conditions and policy documents and letters and emails, and turning them from something that was previously incomprehensible into something that more people can understand.
So you guys really kind of geared into that, looking at the way in which financial services firms talk about money and the language that they use to describe it and the difficulties that can arise in that. And I think that's going to be very, very helpful in today's discussion. Robert, give us a bit of background about yourself as well.
Well, so Wealthtime, who I work with, is both a financial platform and what we call a DFM, so discretionary fund manager. So I run the investment, DFM is the investment side of the business. So I run that, and that's really my main background, is I've a lifetime in investments. But on the platform side, obviously it's complementary. And on both the DFM and the platform, Wealthtime, we have a very simple goal. We want to be the leading DFM and platform in retirement. So we've gone through a bit of a journey over the last 12, 18 months where we've looked at what the ultimate client offering is. And our clients, to be clear, are IFA firms. And obviously the end client is who they do. And get a bit like our colleague here, we've had to employ lawyers through the consumer duty process to look at all our documentation and look at the way we define things and describe things, and can we make it simpler? And I have to say, even when we pay vast amounts of money for a law firm to review things, I still read it as someone approaching retirement, if I put it that way, and still find it very complex. So the topic of today is very relevant, and we all have a long journey to go on, I think, to make things simple.
So that's instructive, isn't it? I mean, you as someone who's kind of worked at the coalface of this kind of sector and is kind of very familiar with how everything works. You're still finding yourself looking at it and then going, okay, this is This requires a bit more explanation, or there's a lack of transparency here, perhaps.
Yeah, I mean, I'm towards the end of my career, I'm very plain about that, and post 50, up to 50, I was like everyone, I see it with my kids and everything now, is you don't really focus on it that much. You just get, most people work at a job, they get a salary, they know they pay into their pension and their company contributes, and it's all fine. But suddenly you get past 50 and you're thinking, oh, okay, what does that mean? How much money do I need in retirement? And I think the biggest change, I suppose, in my lifetime is, if I think about, my parents, my father, when he retired, the reality is he probably had a very short life expectancy beyond that. And it was true. He probably lived 3 or 4 years past retirement and then passed away. Now it's going to be 20, 30, 40 years past retirement. And suddenly you have to think more and more about, do I have enough money to see me through that period? And we have to answer the basic questions. What is enough money for people? How do they know what they need to survive? And then you have a government policy which previously has been getting people at 55 go and cash in and go for a cruise. I've never quite understood that, because you then see the impact that has on people who realize they don't have enough money when they're getting through to their sort of 70s and 80s and beyond. So this is a hot topic.
So, and the nub of the issue here is almost one of, it comes back down to the change we've had in the past 20 years, right? Between moving from a system which is predicated on final salary, right? Where you work your whole life and then you get an income, and then that's that, to defined contribution, where you obviously you get auto-enrolled and that's quite passive and that's fine. But then you get to retirement and suddenly you have to start making decisions about that. And that's very different to the world of final salary. James, your view on it, do you think, have the companies failed to move on that language in the past kind of 10, 15 years as the system has changed?
Yeah, I think that it's perhaps worst in investment platforms, pensions, this market than anywhere else in financial services. And we see, the average length of investment platforms, terms and conditions are 22,000 words, and they have a reading age of over 18. And just for context, the average, 1 in 6 UK adults has a reading age of 11 or less. So, what people often say when you say, oh, well, this has got a reading age of 18 is, well, that's fine. It's only for adults. But actually, if something has a reading age of 18, it is very hard to get your head around. And reading ages are just a simple way of looking at the average length of words and the average length of sentences in a document. So a high reading age is long sentences and long words, and it stands to reason that stuff is much harder to read and harder to understand. And I think, before Consumer Duty, we were banging the drum around this, and certain sectors were more amenable to trying to make progress than others, particularly ones where they had a more active customer base and needed to try and sort of win trust because customers were more engaged with their products. So there were some banks around the edges, particularly challenger banks, some insurers rewriting their policy documents and terms and conditions. The pensions investment sector hasn't really lent into this challenge until Consumer Duty has come around the corner. And I have to say, I think, it doesn't really feel like we've seen liftoff yet. There's a few examples where firms are starting to try and get to grips with this. But as you say, there's an awful lot of jargon and complexity in this sector. And a lot of people just throw their hands up and go, well, nobody reads this stuff anyway. Do we really need to try and rewrite these complex legal contracts in plain language? But the answer to that in the Consumer Duty world is yes. You have to prove that your customers can understand your documents. And I think, investment and pension providers have got a very long way to go until they could say that their customers can understand it.
So that Consumer Duty is it's the big regulatory change that's kind of what has now landed and taken effect. And this is forcing companies to stand up and take, would you say, a lot more notice than previously?
Yeah, 100%, because the sort of overriding principle that underpins Consumer Duty is that you have to prove you're working to deliver good outcomes for your retail customers. So that's the starting point. But underpinning that, there are 4 outcomes, one of which is the consumer understanding outcome. And that one says you have to prove that your customers can understand your products and literature and communications. And that's a very high bar, because actually in the past, if you'd asked anybody if their customers really understood their small print and communications, most companies would probably go, well, no, but nobody really reads this stuff anyway. So, it's on the long list. Whereas over the last couple of years, firms have been racing to try and make improvements. Some of them have really leveled up to that challenge. I think some of them have sort of had a go at it and found it a bit difficult and moved their document on a tiny amount. And then, they're still looking over their shoulder thinking, particularly in investments and pensions, doesn't look like many of our competitors have made much progress. So maybe we'll get away with this. But I think the reckoning is coming for jargon in this sector.
Yeah. I mean, thinking back to why the jargon exists and why this kind of complex language took hold in the first place, Robert, from your perspective, what do you think is behind that? Is it a kind of hiding behind the complexity, or is it saying, look, this is actually really difficult, you should just trust us to do it for you? What do you think the motivations are there?
We're living through it right now. When we have our terms and conditions are sitting with a law firm who are completely rewriting our terms and conditions on the back of Consumer Duty and the FCA thematic review around retirement, so Financial Conduct Authority review around retirement. Mm-hmm. So how it is, I'm expecting it to probably be 3 times as long as it was initially, although they'll have some artificial intelligence overlay which will try and make it simple to read. But for all the stats you gave out earlier, no one's going to read these documents, but we have to have them. And it's really for us in a regulated environment to tick every box we're asked to tick. And it is a painful and expensive process. And ultimately, we all use language about, the right outcomes for clients. But actually, you have to ask yourself cynically, because they're not going to read it, is it actually doing the duty, the job it's meant to do? But it's that we are in a regulated environment is why it's so complex and so long and so detailed. And it does detach us from, the end game, which is ending up, do we have suitable products that people could actually purchase? Which, we can touch on in due course, but regulation is why it's so complicated.
But I think there's a couple of points there. I mean, one is, how do you ensure that customers understand everything that they need to understand when they're buying these products? And, if we know that customers don't read this document and that document, then we can discount that as being part of the education process. It's not enough to go, we told them to read the terms and conditions and they didn't read them. So, under Consumer Duty, if you know that there are still issues with comprehension, you need to be doing something, and you need to be sort of testing and proving through testing that customers are understanding the key bits of information. And so, that may not be through T's and C's. Almost certainly it won't be. It'll be through emails. It'll be through additional messages that you're sending to customers during the life cycle of their product. It'll be information you give them when they log into a portal. It'll be through text messages. It'll be through videos that you serve up to them. But what you need to prove is that you're doing everything you can to close that gap in understanding. Alongside that, you do also then have to ensure that all of your consumer-facing documents, even the ones that aren't really read, are understood by customers and written in a way that they can understand. And of course, most customers won't read a T's and C's document, but these are manuals. It's not, none of us open the glove box when we buy a new car and pull out the manual and go, right, page 1, let's get going. But, we might have a query eventually, and then we'll pull it out and read it at that point. If you look at most investment T's and C's, they are structured as sort of legal protection documents for the firm, not with the customer in mind at all. Without blowing our own trumpet too much, I think, we often see that when lawyers come in and do these rewrites, they really struggle to break away from all of that jargon, because it's sort of what lawyers trade on in a way. So when we go in and write T's and C's, we kind of have the lawyers, the product guys, the underwriters, everybody around the table, and try and sort of get them to break this down into what they're trying to say in a language that people would actually use. And it is harder in investments than anywhere else. But I don't think that we've yet seen the breakthroughs here that are certainly possible.
Yeah. But later this month, we're obliged to send out our revised T's and C's to every single one of our, the IFA clients who we serve. So we've got to go to the IFA with the document, and then we're obliged by the regulator to then send it directly to the end client as well. So they're going to get this massive document through, and it worries people because they wonder why they've got it, and they may end up filing it, whether they file it in the bin or file it at home somewhere. We end up finding that our call centers get inundated with calls because people are worried that what does this mean, getting this revised document? And that's one of the challenges we have, because then you get call centers who get an exponential number of calls on a particular day. People are hanging on for 30 minutes, 45 minutes because the volumes pick up so much. It's just a never-ending, if you like, downward spiral we find. And what would be perfect is for the IFA who has that relationship with the end client to actually be able to ring them up as part of their annual review and say, look, this is where we're going. But again, we're forced into certain deadlines that do oblige us to send out probably more correspondence that we think is healthy to that end client.
Well, I think the potential for Consumer Duty is actually to start tearing up some of that prescriptive part of the rule book that everybody hates. Certainly, in the Labour Party's paper that they wrote about their plans for financial services, if they were elected, they said that they wanted to use Consumer Duty to start tearing up some of the rule book. And I think, the rule book has got very large and very prescriptive, particularly in the investment space. So there's an opportunity there to step back and say, all right, we're not going to force you to send all these 15 pieces of disclosure. What we're going to do is get you to prove that your customers understand this stuff and are taking the right decisions as a result of that. And I think that's where we will see things move to over the next few years. But it's still going to leave that challenge front and centre to tackle this jargon problem.
So, it does, in a sense, it reflects the way that the products and the sector work as well, right? They are, by their nature, there is a level of complexity to this stuff. And when you come to retirement, you have to make a series of choices, right? Is there an issue there?
Well, I have concerns around the product. So when the regulator came out with their thematic review on retirement recently, they're taking us on a journey. And so they're saying probably that you have a centralized investment proposition initially. So what you do in the accumulation phase of building your wealth initially, building enough money for retirement. And then there's the point once you retire or come up to retirement, do you invest in a different style? And there are very few firms. We did a survey recently of our clients, and it was something like 10% of them actually had a different strategy for people in retirement for the investment phase. So in itself, it has been relatively simple to date. You've had people who start off predominantly in equities, and then they de-risk because they get near retirement, and they retire, and they might have changed it. But that was when there was a correlation, or inverse correlation between equities and bonds maybe, and that broke down a few years ago. And so suddenly people were losing money on equities and bonds, and that pot of money they'd built up in retirement was disappearing rapidly. Correlations have come back a little bit now, but not totally. So we've been looking and trying to encourage our clients to look at the accumulation phase, probably until that sort of mid-50s age, and then have a regular annual dialogue with their clients to say, you should look at now creating a retirement investment pool. That's what we call a centralized retirement proposition, a CRP. And just every year, just begin to, rather than just de-risk the equity pot, actually think about how you build up something that in income will give you that regular income in retirement, whatever that income should be. So the products haven't really matured enough for the fact we're all living so much longer in retirement. And that, I think, will be one of the sea changes, because it's difficult to have simplified documentation if we haven't got a clear investment process that people should be going through.
So what are the implications of that would be that people end up with inferior retirements because the complexity is just making it worse. Is that?
Yeah, well, at the moment, they have I would say that pot of money they have saved up in their SIP or, through their work retirement schemes. That pot can decline. You get a bad run, as we had sort of in the, 2 or 3 years ago, and it can suddenly disappear. And the biggest fear, so again, when I started and said, as I'm probably near retirement than a number of people, you think about how much money you need and what income you probably need to offset the fact you're not getting a salary anymore. And you need that for 20, 30 years. You do a lot more. I do a lot more planning around that now than I ever thought I would do, and probably ever needed to do 10, 15 years ago. But I would say the products to make it simple, make those choices simple. You want a menu. I would argue you want a menu, A, B, C, depending on your view of certain things. We're a long way from having that menu. And indeed, our own, at the DFM side of Wealthtime, our own investment products were really complicated a few years ago. And actually, we've just got rid of them and come up with things that are a lot simpler, that are looking at developing sort of income, and almost an element of it is what we're recommending to people, which is sort of guaranteed income in effect, to say, pay your basic bills, and then everything else you can take a view about how much risk you want, but focus on things that are, you're not going to have those tech stocks that have done fantastically well of late. You're going to be thinking much more about value stocks and consistent, relatively de-risk investment styles.
So is the companies you work with on these sort of issues, what are their priorities tend to be going in? Are they protecting themselves, or are they thinking, no, we need to improve outcomes here? How are they approaching things?
I mean, you find competing priorities within different departments within each organisation. So, the legal team are often most worried about protecting the company, and actually, certainly pre-consumer duty, that was where a lot of projects failed, because legal team would sort of have final sign off and come in late in the process and say, oh no, you can't say all that stuff, we need to include these pieces of jargon that we've used for time immemorial. And I think post consumer duty, more firms are understanding that they've got to face up to the challenge of getting this stuff as clear as possible, and then because in some organisations there isn't a huge volume of literature to deal with, then the first stage is prioritising that and thinking, okay, which of our communications have the highest impact? Which are the ones we really need to get straight? And, in a lot of cases, of course, that's letters and emails that are sent at key points in the customer journey. We know one firm that's invested in new text messaging technology and is now sending 3,000 text messages a month or something like that. And of course, the way that consumers engage with information is constantly changing, and that is something that firms have to be mindful of. It may be effective today to send a letter, follow up with an email, and follow up with a text message, and you might be confident that actually one of those three communications is going to get read. But once we've all been spammed to death with text messages, everyone might stop reading their text messages as well as their letters. And so that's another challenge for firms to think about.
That was going to be my next question, because my experience. I'm 35, so my patient provider, they never ever contact me ever, because it's just sat doing whatever it's doing, kind of thing. But when I get contacted by my bank, it's always kind of like you get a text message saying like, "Oh, hello, you've got a secure document in your system to go and look at," and you go and look at it, and it's like, we've done this absolutely vague thing that's of no consequence to anything at all. And you just kind of like, well, that's 5 minutes of my day. Come on.
It's when they also ask you for the passwords. You got to they're chasing you, and then they ask you for the password. So I always find I don't want to give you my password,
So my question there is there too much? Is there such a thing as too much communication?
Yeah, absolutely. You've got to get the right balance, because, as you perfectly illustrated, if you keep getting messages that are wasting your time, then you start to tune out to them. But, what I also thought was interesting that you said there was that your pension provider never contacts you. Well, that's a problem. And it's part of the problem in this sector, in that, actually they should be contacting you, not just sort of taking their fees and thinking, that's fine, we'll get in touch in 20 years. They should be thinking, are you saving enough for retirement? Do you understand how much you need to have in retirement, and understand what your goals are, and trying to engage you on that on a constant basis, at least on an annual basis. Whereas at the moment, a lot of firms don't. And it's that passivity, I think, that means consumers are so underprepared when they get to retirement and now have these really big decisions to take and a whole bunch of jargon to engage with, which perhaps before they've not come across.
The Conservative government, Jeremy Hunt, as the Chancellor, said they were going to consult on pot follows member and, pot for life and that kind of stuff, which would be quite a big sea change in how the kind of DC, pension system works. Do you think that would chivvy some of these companies along to be a little bit more careful about, keeping customers, engaged and clued up, because you're moving from a system where your workplace just picks on you for you and you just sit with it, to a system where the consumer, the individual, can say, well, I don't think you're really doing it for us, so I'm going to go to this other provider. Do you think that could help?
I mean, I actually think it would have the opposite effect. It's sort of more passivity, isn't it? At the moment, at least, every time you move to an employer, you end up sort of engaging with the system, and briefly, maybe you don't if you're auto-enrolled in, but at least you sent a bunch of stuff and said you're in the pension scheme here. If you have a pot for life, and it just kind of follows you wherever you go, there's the risk that you have even less engagement with the customer over the lifetime. So, I think it's a challenge for the pensions industry to try and find ways of keeping this debate and, that the whole thinking about retirement alive through people's life, rather than just waiting until, they're approaching retirement. Of course, that's a challenge. People in their 30s are generally not that interested in it, but it's something that we've got to work at.
Rob, on the advice side of things, I mean, obviously an advisor is supposed to kind of be hold the hand of the customer. So I'm assuming they're going to be engaging the customer more than a pension provider, right?
I mean, they are, and you'd like to think they were, but, and again, back to Consumer Duty, what has happened is we're seeing a lot of IFA firms that are having to be clearer in terms of justifying their fee and the advice. And one of the lines we're taking with them is, if you gradually transfer people, into a separate investment process for retirement, at the age of 50 plus, every year you're actually doing something for that client, where ordinarily for an advisor, maybe every 3 or 4 years, there's something you need to do for the client. That you're buying a house, kids are getting married, something, but you're not actually, most years you have nothing really to do with them, and you're charging quite a lot of money usually for that privilege. So I think if every year you're trying to move their investment story, you can see a lot of them, their eyes light up and they go, oh yeah, I can justify my fee. Now, they should do more than that, but that's where we are. But they need that definition of what is in retirement. And just to the earlier point about Jeremy Hunt's point, and does it make life simple? It does to a degree, but I do accept it will just mean people will just forget about it longer. But it has to come on the other side with a series of products or investment guidance that people can understand. Then maybe you can get over that hurdle. But at the moment, because it's such a complex area, different people, you've got annuities out there, you've got lifetime investment products, you've got all sorts of, I think we're at the cusp of a bunch of new products probably coming out. But again, every firm will have a different take on it, and that will probably add to the complexity rather than take it away, until those new products, if you like, get embedded in and the language around them become the norm, and people are confident in it. They're scared that they get it wrong in retirement. That's the other thing.
I mean, I talked about the move, the shift from final salary to DC at the beginning, and someone explained it to me once, that the failure of government to educate around that change is what has led us to where we are now, with the difficulties of explaining actually the way your pension works now is not just a pot that one day suddenly you can just draw upon. That financial education, I mean, do we start schools with that and continue that in workplaces? Who do we think holds ultimate responsibility for that?
Well, I think you do have to have some of it in schools, and there is some of it in schools. But the best time to talk to people about financial products is at the moment when they're thinking about them. And I think the workplace needs to do much more. At the moment, as we've said, it's a very passive decision. It's designed to be. It's designed to just kind of make sure that people have got some pension provision and go, don't worry, you don't need to do anything. We've started a pension for you. But there's a missed opportunity there, and obviously in smaller employers, it's very difficult for, the local fish and chip shop to be laying on pension training for their staff. But, I think there was always a bit of a missed opportunity when they set up what is now the Money and Pension Service. That all started off with the Torreson Review about 20 years ago, when they were thinking about, how do we enable consumers and support them in making better financial decisions? And what ended up of that was what is now MAPS. But, I always thought that actually one of the things that should have come out of that was a much greater focus on getting financial education into the workplace and supporting people to make better decisions. It's not just about pensions, but also about life insurance and protection and other financial products. But unfortunately, that's not been something that's been grasped yet.
If I can say, there is the demand for it, though, because with our view of wanting to be the leading firm in retirement, we had these series of roadshows you alluded to earlier, and suddenly we thought, we've got some great content here, some great videos we put together. I wonder how many of our staff actually know, if the elevator conversation, how do they describe Wealthtime? And so we've put together a series of training programs for internal staff, and we have about 320 staff. It was a voluntary scheme. 250 within about a day, when we said we're doing this series of training of 2 months, signed up to it. And actually it made us think, as you alluded to, our own staff in the financial services world really don't understand their pension system and what we're doing. And because, again, the investment side of Wealthtime is not obliged from a regulatory point of view to actually manage their pension anyway. So we have a third party come in and do that. They don't understand that, and they don't understand all those issues around it. So we've put together quite an extensive program now for our staff. But I think we had rather complacently just thought they all knew it because they were in financial services. And if they don't know it in financial services, elsewhere they're not going to know it either. So I agree, the fish and chip shop can't do it, so we have to think about that. But for firms over a certain size, clearly the demand is there and the expectation is there that we could and should educate them. So we've been pleasantly surprised by the response.
I mean, I think when you look at the kind of the sector and who are the kind of dominant players, I mean, there's one that sticks out, right? It's Nest, are huge, and it's government backed. So you'd think, do they, need to push more from their perspective? Are they? I don't know. Have you ever dealt with Nest?
Yeah, no, I know Nest.
I mean, I remember dealing with them a few years ago, and I kind of asked them about things like the default fund and that kind of stuff that they have, and they and you look at the kind of how the portfolio is balanced, and it's actually. And I asked, well, this is it's quite conservative for somebody who's conceivably going to be 21 years old in this fund, and they were like, yeah, well, we tend to find that if you put something in 100% equity and they lose a load of money immediately because of the market doing something, completely random, then that tunes them out forever. They never engage in it because they lose, So is there, I mean, leading up to a question here is there a risk-averse mindset? Is there a good thing in that? And is there bad in that as well? Kind of trying to mitigate that risk?
Well, I mean, I think that there's an education piece there, isn't there? And I don't think we should be sort of pandering to people's misunderstandings of the market if that's acting against their interests. But I think that Nest does understand that it's got an opportunity to lead the way. I know at the moment they're frustrated that they can't be involved in the decumulation phase, and that's something that they want to be part of as well. And of course, there's a great opportunity for them to show the industry what is possible in terms of communicating clearly and engaging their members throughout the life cycle of the product. But yeah, I wouldn't necessarily advocate for them trying to keep young customers in lower risk portfolios because of their fear. I mean, I think they should try and engage them in that decision ultimately and say, what is your appetite for risk? This is what we would recommend for someone of your age. It may mean some ups and downs along the way, but over the last 100 years, this is how equities have performed and this is why we think it should be there. But, if you've got a slightly lower risk appetite and you don't think you can stomach the ups and downs, here's another option for you. But of course, the risk here is if you look at how that's performed over the last 100 years, it's quite a lot less, and then leave it up to people to make their own decisions at that moment.
So just thinking about how we solve this kind of the jargon barrier and the complexity and that kind of thing, Robert, from your perspective, what are steps that we need to be, moving towards now to simplify and improve the situation?
So I think there's two phases. There's you need simpler products that are out there that people they can understand, that the jargon's removed from the product. It's, there's an accumulation phase, decumulation phase, the transition period, and everything around that should be relatively straightforward. And I actually am a big believer that artificial intelligence will help us all do our jobs a lot easier, because people will be able to go and get a fairly simple solution that is, to the 21-year-old may want a different explanation to a 45-year-old or a 60-year-old. And I think we'll be able to get that. Whereas if you have something that is trying to catch it for everyone, it's complex. Where I've seen some of the things that ChatGPT can do now, and it is phenomenal to sort of change the world. And we internally, use one of the Google apps now for artificial intelligence, and it's just it is revolutionizing the way we do things. And suddenly you get the write-ups of these documents and some of the meetings we have, and you think it's really quite good. It's better than I could have done it. So I think that helps. So you have the simple products, and then you have to have simpler explanations around it that do match the individual. I think AI might get us there. The overlay and the complexity around that is what the regulator allows us to do, to make sure we do tick the boxes that we rightly need to do, that we're, that it is getting the right outcomes for clients, that those people that abuse their position in financial services can't somehow get around this. It is always the bad penny that causes all these problems for all of us. And I'm not sure the regulations ever really capture those people, who are going to exploit, sometimes quite elderly people. I've been through it with, parents who, are beyond the point of really ever going to understand what they're doing. And it's a concern you see when they get those cold calls and they kind of ring up. I had my mother ring up in tears the other day because someone had called up and was asking about passwords and everything else. I don't think she gave them anything she shouldn't have done, but that again makes all our lives a lot complicated. So you have to have checks and balances around that. But yeah, I think it's working in conjunction with the regulator to allow the market to target individuals and give them the type of language and documentation that is suitable for them out there, reflects their age, their lifestyle, their education, if you like, what they can and can't. The stats you came out with earlier on, were quite shocking about people's reading levels. Mm-hmm. So we do need to explain it better. And the use of podcasts and audio and video coupled with AI will improve things, but it's a long journey.
Yeah. James, really pulling it back to kind of what people should do in this kind of situation and thinking about, okay, I'm in this position where, I'm about to start using retirement income and this kind of thing. What would you say is kind of a key thing for them to do and steps to take to kind of ensure that they're able to understand, what they're facing and what to do next?
Well, I think if you've got a big enough pot, then you should be seeking some advice and getting somebody to hold your hand through the whole process, because it's such an important moment. But, there are, government services available that you can use for a bit of support. But, don't try and necessarily become an expert in pensions overnight. Make sure that you're getting some advice and support from people that know this stuff inside out, because making the wrong decisions at that moment in life can be catastrophic and really change what your retirement looks like.
Yeah. And for the industry, looking as you do as a kind of holding hands, what can companies be doing to pull back that jargon and reflect on the way they use language?
I think they need to be honest about the complexity of the sector, and of course, simplifying products will help. There are still products out there that use derivatives, have sort of complex counterparty structures in them, which the average customer, or the vast majority of customers are going to struggle to get their head around. And maybe, let's keep those out of the mainstream if you can't explain it sort of fairly simply. But even then, even the what we might deem to be relatively straightforward products are still surrounded by jargon, the names of all of the different asset classes and, phrases we've been using today, accumulation, decumulation, drawdown, all sorts of jargon. And I think the industry just needs to lean into that and go, okay, what can we dispense with? What can we use everyday words for in place of ones that we've been using for years that are unnecessarily complicated? And in those areas where we absolutely can't, let's follow up with plain English explanations to help unpack that and use examples. And I don't feel that much of the investment and pensions market has lent into that challenge yet. And, I hope that that's where they're going to go over the next few years and what Consumer Duty drives them to.
Your team must have that George Orwell rules for writing stamped on the wall, right? What is it? Don't use a complicated word where a simple one will do. That's kind of a rule for life, isn't it?
Yeah, we wrote a guide to clear communications for the ABI and its members, which you can pick up online for free. And you read through it. None of it is rocket science. But actually, it's amazing how much of the financial services industry struggles to break away from communicating in the ways that they've been doing for the last 20 or 30 years. It feels a bit dangerous, especially to say legal and compliance, because they're thinking, is it okay to use this very simple word here when we've been using this complicated one and everyone else uses it? Will it put us in a legal position that weakens us? But in reality, 99% of retail financial services complaints fall to the Ombudsman, and the Ombudsman is looking at whether you're fair and reasonable, and the Ombudsman is now looking at Consumer Duty and whether or not you're communicating in a way that your customers could understand. And in the unlikely event you end up in the courts, we've got the Consumer Rights Act, which says that firms need to communicate in plain and intelligible language. Otherwise, their terms may not be deemed transparent. So, that would mean they're ultimately unfair contract terms and unenforceable. So the legislative and regulatory framework is all saying simple language, you've got to use simple language. So it's a challenge that everyone's got to lean into.
Yeah. And Robert, I mean, I get the sense that the Wealthhtime are trying to lead something of a charge on trying to simplify and encourage the sector to move forward. Would you agree with those sentiments then broadly?
I absolutely agree with the sentiments. I mean, the irony is we've probably tripled our compliance department over the last 18 months to deal with Consumer Duty, the thematic review, all the things around it, because we want to make sure we are compliant. But when you end up with a room full of compliance officers, the natural default is to extend the language on everything. So it works both ways. We're trying to protect our position and do what's behind the spirit of Consumer Duty. But sometimes I think we end up in the wrong place. So we are trying consciously, holistically, to simplify as much as we can, so all of us, down to sort of the new starters in the firm, everyone can explain what it is we're doing and what that retirement story is, so that the level of understanding is much, much greater than it has been. We'll suppose in a few years' time we'll see if we get there.
I feel like we will see. Thank you both. A really, really enlightening discussion from, I think, two really interesting perspectives. Thank you, everybody, for listening to the Mouthy Money podcast. You can follow us on Apple, Spotify. We are now on YouTube as well. And of course, we've got a weekly newsletter and everything else on the website. So James and Robert, thank you. And thank you to everybody for listening. And we'll see you again soon. Thank you.